This past spring, the Federal Reserve led the Supervisory Capital Assessment Program, SCAP, sometimes known as the stress test, a coordinated, comprehensive examination designed to ensure that 19 of the country's largest banking organizations would remain well capitalized and able to lend to creditworthy borrowers, even if economic conditions turned out to be worse than expected. The release of the assessment results in May increased investor confidence in the U.S. banking system. A week ago, the Federal Reserve announced that 9 of 10 of the firms that were determined to have required additional capital were able to fully meet their required capital buffers without any further capital from the U.S. Treasury, and that aggregate Tier 1 common equity at those 10 firms increased by more than $77 billion since the conclusion of the assessment. The Federal Reserve will continue to work with banks to improve the access of creditworthy borrowers to the credit that they need. Lending to creditworthy borrowers is good for the economy, but it also benefits banks by maintaining profitable relationships with their customers. We continue to encourage banks to raise additional capital to support their lending. And we continue to facilitate securitization through our Term Asset-Backed Securities Loan Facility, or TALF, and to support home lending through our purchases of mortgage-backed securities. Normalizing the flow of bank credit to good borrowers will continue to be a top priority for policymakers. While I'm on the topic of bank lending, I'd like to add a few words about commercial real estate. Demand for commercial property has dropped as the economy has weakened, leading to significant declines in property values, increased vacancy rates, and falling rents. These poor fundamentals have caused a sharp deterioration in the quality of CRE loans on banks' books and of the loans that back commercial mortgage-backed securities, or CMBS. Pressures may be particularly acute at smaller regional and community banks that entered the crisis with high concentrations of CRE loans. In response, banks have been reducing their exposure to these loans quite rapidly in recent months. Meanwhile, the market for securitizations backed by these loans remains all but closed. With nearly $500 billion of CRE loans scheduled to mature annually over the next few years, the performance of this sector depends critically on the ability of borrowers to refinance many of those loans. Especially if CMBS financing remains unavailable, banks will face the tough decision of whether to roll over maturing debt or to foreclose. Recognizing the importance of this sector for the economic recovery, the Federal Reserve has extended the TALF program for existing CMBS through March 2010 and for newly structured CMBS through June. Moreover, the banking agencies recently encouraged banks to work with their creditworthy borrowers to restructure troubled CRE loans in a prudent manner and reminded examiners that, absent other adverse factors, a loan should not be classified as impaired based solely on a decline in collateral value. In addition to constrained bank lending, a second area of great concern is the job market. Since December 2007, the U.S. economy has lost on net about 8 million private sector jobs, and the unemployment rate has risen from less than 5% to more than 10%. Both the decline in jobs and the increase in the unemployment rate have been more severe than in any other recession since World War II. Besides cutting jobs, many employers have reduced hours for the workers that they have retained. For example, the number of part-time workers who report that they would like a full-time job but cannot find one has more than doubled since the recession began, a much larger increase than in previous steep recessions. In addition, the average work week for production and non-supervisory workers has fallen to 33 hours, the lowest level in the post-war period. These data suggest that the excess supply of labor is even greater than is indicated by the unemployment rate alone. With the job market so weak, businesses have been able to find or retain all the workers they need with minimal wage increases or even with wage cuts. Indeed, standard measures of wages show significant slowing in wage gains over the past year. Together with the reduction in hours worked, slower wage growth has led to stagnation in labor income. Weak income growth, should it persist, will restrain household spending. The best thing we can say about the labor market right now is that it may be getting worse more slowly. Declines in payroll employment over the past 4 months have averaged about 220,000 per month, compared to 560,000 per month over the first half of the year. The number of initial claims for unemployment insurance is well off its highs of last spring, but claims still have not fallen to ranges consistent with rising employment. Although economic pain is widespread across industries and regions, different groups of workers have been affected differently. For example, the unemployment rate for men between the ages of 25 and 54 has risen from less than 4% in late 2007 to 10.3% in October, nearly double the rise in unemployment in adult women. This discrepancy likely reflects the high concentration of job losses in manufacturing, construction, and financial services, industries in which men make up the majority of workers. From the perspective of America's economic future, the effect of the recession on young workers is particularly worrisome. The unemployment rate among people between the ages of 16 and 24 has risen to 19%, and among African American youths, it is now about 30%. When young people are shut out of the job market, they lose valuable opportunities to gain work experience or on-the-job training, potentially reducing their future wages and employment opportunities. Given the weakness in the labor market, a natural question is whether we might be in for a so-called jobless recovery, in which output is growing, but employment fails to increase. Productivity is defined as output per hour of work. Thus, essentially by definition, a jobless recovery, in which output is growing but hours of work are not, must be a period of productivity growth. In the jobless recoveries that followed the 1990, 91, and 2001 recessions, productivity growth was quite strong. It may seem paradoxical that productivity growth, which in the longer term is the most important source of increases in real wages and living standards, can have adverse consequences for employment in the short term. But when the demand for goods and services is growing slowly, that may be the case. In fact, productivity growth has recently been quite high, even when the economy was contracting. Output per hour in the non-farm business sector is estimated to have risen at about a 5.5% annual rate so far this year, well above long-term averages. One reason for recent productivity gains likely was the reaction of employers to the free fall in the economy that began in the second half of 2008. Normally, employers are slow to cut their workforces when the economy turns down. The process of finding, hiring, and training new workers is costly. Thus, if employers expected that the downturn will be neither not too severe nor too lengthy, they retain more existing workers than they need in the short term, rather than laying them off and then trying to replace them when the recovery begins. However, in the recent downturn, employers were exceptionally uncertain about the future, some even fearing a second Great Depression. Moreover, tight credit conditions left little margin for error. Accordingly, to protect themselves against the worst possibilities, employers shed workers much more sharply than usual in recessions. Thus, the productivity gains this year generally reflect pronounced declines in labor input rather than greater output.